So good morning, everyone. We'll go ahead and get started. Wes and I showed up this morning, and he looked at me and I looked at him and said, "What the heck?" Wes said, "At least I'm not wearing a pink shirt." So quite funny, blue jacket and gray pants, and I've already gotten several text messages. So it was not planned. But anyway, my name is Brent Miller, Managing Director with SVN Miller Commercial Real Estate. And we'd like to welcome you to our 12th annual Commercial Real Estate Forum. Our mission here at SVN is to create amazing value with our clients, colleagues, and communities. And this forum is just one example of implementing that mission. We're excited to partner with Salisbury University again. However, due to the current environment, we are hosting this event virtually. We've teed up a great agenda of dynamic speakers that will enlighten you on economic trends and post-COVID forecasts on a national, regional, and local level. In order to make this as interactive as possible, we welcome and encourage your questions. Please feel free to type in your questions in the Q&A box. Now, I'd like to introduce Wesley Cox, a senior advisor here at SVN. Wes is a CCIM, has been in the commercial real estate business for 19 years, and is a key member of the HANA team, who ranked 18th in this past year out of over 1,300 advisors nationwide. Wes has been providing a local market update for this forum since its inception, and we are very fortunate to have his insights to share with you today. Wes, take it away.
Thank you, Brent. I'm going to go ahead and start. I'm going to pull my slides up here before I get started, so just give me 1 second to get those shared with everyone. All right, there we go. Everyone should see that. So thank you, Brent, for the warm introduction. As Brent said, this is our 12th annual event. I think you said that anyway. So this is our 12th annual event. This year, of course, we're having to do things a little bit differently these past 2 years. We've had to adapt just like many of you guys on the call. So here we are virtually yet again. But thanks so much for joining us. So we've had an interesting year, right? A lot of unfamiliar territory, lots of uncertainty, yet in a time of a pandemic, we've had really surprising results. I'm going to share some of those with you here today. So our presentation is going to be a little more brief to this year. In the interest of time, we've kind of condensed it from previous years. So I'm going to go ahead and get right into it, starting with the total number of active listings for the lower Eastern Shore, covering Wycomico, Worcester, and Somerset County. So one of the most talked about issues in real estate today that we all hear about, whether it's locally or even on the national news, is the residential inventory. Well, the commercial market has had a similar problem as the residential market, however, not quite as severe as the residential market inventory levels. We are at a really critical point in inventory, with some sectors having very severe shortages, such as warehousing, industrial, and investment properties, quality investment properties priced right. Now, we're doing more and more work over in Sussex County, Delaware. We have an office in Sussex County, Delaware. We do quite a bit of work up there. So I felt like I'd give a snapshot of what their inventory level is looking like as well. So this is just the number of new listings for sale in each of the years that are shown on the graph. This is not the total inventory, just the number of new listings signed up for each given year. You can see dramatic drop off in 2020 from a slight rising trend or a healthy rising trend for the previous 4 years. We're down about 20% in number of new listings in Sussex County. Now, this is the number of sold properties back to the lower Eastern Shore, again, Wycomico, Worcester, and Somerset County, just those properties that are sold reported through the local MLS. One of the biggest reasons for our inventory shortage is just the overall demand for commercial real estate. And this slide shows that we're at an 11-year high for the number of sold properties. In 2020, we were up over 30% from 2019. So you can start to see some market forces happening with dwindling inventory, rising sales, and we're going to circle back to that here in a second on what that could result into. So dollar volume sold, this is consistent with the number of sold properties that I just showed. This slide is going to show you the total dollar volume of those properties that were sold just on the previous slide. and a substantial increase over the last 5 years of 314%. When I started putting these numbers together, it was just shocking to me, given the year that we had just went through in a pandemic. Just this past year, up over 50% from 2019. So again, pretty surprising results, even for myself, that was in the middle of it, going through all this. So this is going to be a really interesting or cool chart for those of you that have an economics background. I've never showed a slide like this before, so I thought I'd put it together thanks to my good friend Bill McCain, who does his presentation, and he put a similar slide together, but it was more for the residential market. So I don't have a lot of time to get too deep into the analysis of this particular slide, but the real main takeaway from this is where the orange line and the blue line, number of new listings versus the number of sales, where that line crosses, that's going to indicate what our local market equilibrium point is. Also known as the point where we have a stabilized market, where there's an even supply and even demand. Now, no market, regardless of what market it is, truly hits that equilibrium point. It's more of a theory. And if it does hit it, it doesn't stay there just due to dynamic market forces. But this will show you just how far off we are from a true actualized stabilized market. Now, one key note on the end of that chart, the far right, you'll see prediction. That's just based off of the numbers that we've seen so far this year. So that's my prediction that I put up there. And you see the numbers going further apart. One of the reasons that we're seeing this too is also the lack of new construction, and the number of sales is outpacing the supply. So I wasn't going to show this chart, but once I put it together, I thought it was too important to see, given, again, most of it is going to be unexpected through the year of a pandemic. What this shows is just the number of reported signed leases in the lower Eastern Shore. So I felt like I really needed to share this since it was totally unexpected to me. We had about a 60-day kind of pause hit, as many of you on call did today, where there wasn't much going on in our business for about 60 days. Not a lot of transactions happening. But what this represents is a really, really strong demand in small to medium-sized warehouses, and as well as from budding entrepreneurs, people that had home businesses or their own businesses just catapulted, so they needed that 1,000 square foot storage space or that 1,500 square foot office space. So those two uses specifically filled in that gap that retail and office demand kind of left behind. So you'll see we were up 26% in the number of signed leases over 2019. And mind you, 2019 and 2018 were really good years. So if I can just sink in for a second, that really shows you what kind of a really strange and dynamic market that we had this past year, and really more importantly, unexpected. At least it was for me. So I'm going to kind of wrap up some of those market statistics and give you a few more key points and key takeaways here. So some of the stuff we've already covered, the number of sales in 2020 was up 31% from 2019, and those number of sales represented a 53% increase in dollar value from last year. So we sold 31% more number of units, and those number of units represented 53% more in dollar volume. What that reflects, of course, is the strong demand for commercial real estate, but also the number of larger transactions that are happening in the marketplace. So the average dollar value of each transaction, I think, went up over $200,000 this past year for the lower Eastern Shore. Just touched on leasing. Number of signed leases up 26% from last year. Again, due to the demand of small to medium-sized warehouses and those entrepreneurial type folks that were coming out of the garages, so to speak, and coming out into the marketplace and leasing commercial space. Current inventory, one of the biggest topics that I've touched on here. So we've already talked about strong demand is really putting a big strain on supply right now. We're near a 12-year low. I think 2009 may have been the lower point in the last 12 years, but we're really close to that, as we saw on the first chart. And of course, sales are outpacing new inventory. So really what this spells out is a lot of good news, but also some potential news that is unhealthy for our market. So with super low supply, really high demand, you can see I put up there, that equals a potential for some really unhealthy price appreciation. Now, we haven't seen that yet, so I don't want to give the wrong impression today. We're not seeing unhealthy price appreciation. However, we're starting to see things that are signs from 2006, 7, probably ended in 7. And one sign of that is we recently settled on a property, I think for around $40 a square foot. I won't get into a lot of specifics here, but just a quick example. That property now today, someone is potentially interested in it. The offering price out there is about double that. Actually, it's more than double that. Now that's just an offering price, it's not a listing out there, but that's the type of thing where we start to see some unhealthy price appreciation, which is a real sign for us to pay attention to. So, talk about pricing really quickly. This is one of the more important points I want to get across today. So in previous years, I've talked about the sold price to list price dispersion. That's just the ratio or the percentage off of the listing price that the average property sells for. This year, it's 11%. So if you list a property for $1 million, it's going to sell on average for around $900,000. Now, this is a pretty interesting number because for about the last 5 years when I reported this, we were about anywhere from 15 to 17%, maybe 18% of a price dispersion. Now it's a much tighter gap, again, showing a greater demand and buyers willing to pay more than what they were over the last 5 years. Average days on market for current properties, this is a number to pay attention to if you're out there looking to list your property for sale. 433 days, or I've done the math for you, that's 1.2 years, give or take, a week or so. 45% of the properties on the market, they've been on the market for over a year. So what's that telling us? It's telling us you're either a really unique property, a niche property, special use type of property, or you're probably priced a little too aggressively, because the next bullet point shows us that the average days on market for those properties that have sold, 166 days. Huge difference, as you can see. These are really important numbers that I take a lot of time and study and pay attention to, because it's really important to educate our clients and folks that are out there looking at evaluating the commercial real estate market, whether you're a buyer or a seller. So my final 2 bullet points today, which are probably the 2 most important points I can get across, because the other stuff is just stats, right? They're going to change. But what doesn't change is that quality properties priced right sell quickly. That's more true today than any other year that we've had. We've been in a rising market for at least the last 5 or 6 years, maybe longer. Those properties that are priced right now, we're seeing a lot more multiple offer scenarios than we've seen in any before, at least in my 19-year history. We're seeing call for offers, best and final offer scenarios, something that's more synonymous with residential real estate. So really, really good things. These are not bad things at all. But what is bad is if you fall within one of those properties that are priced too aggressively, because my last and final point, most important for you to take away today, I think, is properties that are priced right, they sell on average for 9 months quicker than those properties that are priced too aggressively. If you remember anything today, you remember those last 2 points and this last pricing section that I'm sharing with you today. So now, of course, we recognize that all properties, you could be priced right, but maybe you're special use. Maybe you're such a niche property where it doesn't fit within kind of the greater market where the demand is. And that's okay. That's a one-off basis. But on average, when you got 45% properties on the market over for a year, that's probably time to reevaluate your marketing strategy. So that's everything I'm going to share with you today. Much more condensed than previous years, so I hope it provided some useful and helpful information. We're going to get on right through with it. Before that, I want to make sure that I remind everyone to put any questions in your question and answer box in there. We'll go through those, so type them in, and anytime you want, if you direct it toward a certain specific person, just put it in there, and we'll go ahead and try to get all the questions answered. We anticipate we'll have a lot. So I'm going to turn it over here.
And while Wes is pulling that up, we also will be having a 2020 market report, which will go into a lot more detail of what Wes talked about today. a lot of statistics of what happened in 2020 within the counties, within the Delmarva Peninsula. So those will be going out to all of the attendees as well.
Thank you, Brent. We did have one question come in from Todd. Your question wasn't complete, so go ahead and retype that if you will. So what I'm going to do is I'm going to turn it over now to my good friend, Dave Ryan. Dave is a previous professional tennis player. I told him I was going to throw that in there. Now golf extraordinaire. I like taking his money every weekend when we get a chance to. Dave's really a budding golfer out there. But more importantly, Dave's an expert at all things economic development. Dave's been in his position as the Director of Economic Development for Wicomico County for over 20 years. Dave's been instrumental in where we're at in the current industrial market right now here on the Lower Shore. So Dave, I'm going to go ahead and let you have it.
Okay, thank you so much, Wes, and a great job on the market synopsis. As usual, you hit the nail right on the head as far as I can see. I want to start the presentation today by showing you a slide of the unemployment rate for our metropolitan statistical area of April 20 versus that of April 2019. And clearly going from a little over 4% up to 16%. Folks, this impacted about 30,000 jobs in our metropolitan statistical area. I know there's a lot of people joining us around the country. We appreciate your attendance today. And just for clarification, our MSA, or Metropolitan Statistical Area, consists of 4 counties, Wicomico, Worcester, and Somerset counties in Maryland, and Sussex County in Delaware. It's about a 400,000 populated area and a couple 100,000 in the labor market. So significant disruption in the marketplace right after March of 2020 at the onset of the COVID pandemic. And so we had to help our small business community, and they're the ones that really took the brunt of this pandemic. And through the CARES federal program and through state funding, we were able to deploy about $13 million to a little over 1,150 small businesses in Wicomico County, who together represent more than 4,000 jobs within just Wicomico County. 80%, roughly 80% of all of the businesses in Wicomico County employ less than 20 employees. So pandemic hit us quick, it hit us hard, but these funds, just at the right time, up to $10,000, targeting 3 months operating expenses, helped many of those businesses stay afloat during the time when they needed the most, during the time when they were forced to close operations, losing 95%, sometimes in some cases 100% of revenue virtually overnight. And so economists tell us that there's a multiplier effect here, and pick a number, it's 1.5, it's 2, but somewhere in the neighborhood of a $20 million economic impact. We've helped small business community in Wicomico County for the past year or so. And so the pandemic hit us hard, and it hit many communities across America hard. And we're reading articles like in Forbes that people are fleeing these larger metropolitan areas. And if so, does that mean there's a rural rebound in the works? I read another article in Fortune that says, no, they're leaving the larger metropolitan areas, but they're locating within counties surrounding that larger metropolitan areas. Another article says, no, they're leaving the coastal communities and moving inland toward lower cost environments. And yet another one says, no, they've already left the big cities, so much so, there's a lot of vacant space, rents are dropping, and now they're moving back in. So what is it? And what does it really mean to us? Is there this rural rebound happening? I would suggest it is. Not in every rural place in America. And some rural communities have had harder times than others. Some have lost population in the past 10 or 20 years. We're not one of those communities. I would suggest there is a rural rebound, and it's happening right now. And here's why. One, pent-up demand. I was in New England in the fall, visiting companies and prospects, and specifically companies that have operations here and investment here, but with decision-making authority elsewhere. One of those companies was American Cruise Lines and their sister company, Chesapeake Shipbuilding here, which makes 120, 140-foot cruise vessels. And they were citing the demand at the post-pandemic era was enormous. And these are domestic cruises that we're talking about. Try going to dinner in Salisbury, Maryland on a Friday and Saturday night these days without a reservation. There's a lot of pent up demand in the marketplace. There's a whole lot of people have fared horribly in this recession, in this pandemic. On the other hand, there's been quite a few people who've done really, really well. A lot of forced savings. You can't fly in planes. You can't go to hotels. You couldn't go to amusement park or sporting events and other venues. So there were some forced savings, and there is this pent up demand in the marketplace today. Two, demographers tell us a lot of the population growth in the past 10 years have been with these in these larger metropolitan areas. They're accounting for more job growth, more employment growth. What they don't tell us is that's mostly in the first half of the decade. And as rural communities recovered from the Great Recession, especially those heavily impacted in the housing market, more commerce came our way. We saw an increased activity. If you look at demographic trends, the baby boom generation, there's still 10, 15 years to retirement. And a lot of those northern people are still finding this community in our metropolitan area as an attractive source for new second homes or semi-retiring or retiring, especially in Sussex County, Delaware. Last year, there were 4,200 single-family homes built in Sussex County, Delaware. The year before was a little over 3,000, which was a good year, as Wes alluded to in 2019. So demographics are in our favor. Our sector strength, our economic sector strength is strong. Third, so if you're going to design an economy from a blank slate or a piece of paper, this is probably what it would look like, with agriculture and poultry as a very solid foundation. In poultry, you're talking about corporate headquarters, you're talking about feed mills and growers and farmers and R&D facilities and hatcheries and port facilities and airport facilities. It's a strong ecosystem here in the ag and the poultry sector. On top of that, the educational and healthcare sector, very institutional, very stabilizing sectors, and a very diverse manufacturing sector. In Wycomico County, two of our largest clusters of manufacturing is wireless component manufacturing and life science, both animal and health. And wireless component, driven by that 5G technology and the deployment of 5G, bodes well for the future. As does life science. These are companies like Purdue and Age Pharma, or Zoetis and Tishcon and Trinity and Cadista Pharmaceuticals, one of the fastest growing pharmaceutical companies in America today. So we have strong economic sectors that are promoting additional rural growth. And not all downtowns are created equal. In Salisbury, Maryland, the city has invested millions of dollars in its downtown prior to the pandemic and on through the pandemic, burying fiber optic lines, creating new streetscapes, opening the plaza for vehicular traffic. We have a roundabout now. And some drivers are better than others at that roundabout these days. But traffic is flowing, and we've set that platform for future growth to occur in our central part of our city. And so is there a rural rebound? Send in the chat box. Let me know in your areas. Wes, maybe you can monitor that as they come in. Is it happening in your community? Do you believe it's going to happen here? I believe it's happening here, and I believe it will continue into the foreseeable future. From a corporate real estate standpoint or a commercial real estate standpoint, and Wes hit the nail on the head, the market can be categorized by one word, at least in a, I'm sorry, try to bring up another chart for you. One word, and that's tight, especially in the industrial sector. And if you think about it, if we've transitioned from a large manufacturing-based economy into a more service-oriented economy, we're much more resilient. But along the way, we've had to absorb some large industrial space over many years. And for the most part in this community, we've done that. So you look at the Dresser plant, which was 200,000 square feet, that was leveled and made room for new development opportunities associated with Salisbury University. The Crown Cork and Seal was a metal canning factory. Today it's the Crown Sports Complex. Campbell Soup, 300,000. square feet. Moss Hill Lane, 300,000 square feet, was acquired by entrepreneurs, subdivided space, and there's a multitude of tenants in there. So in a large way, we've filled and absorbed that large, and that's the good news. We have less vacancy in the industrial market. It's also the challenging news, as Wes alluded to, because the companies are calling here and they say, Dave, I need 100,000 square feet. I need 120,000 square feet, or 50,000 or 80,000. And the answer is yes, or the answer is no. The speed to market, the need for speed to market is overriding our ability to construct something in a 24-month period. So the industrial market is tight. On the commercial side, or more the retail side, the market is much softer. Here's and I'll point to our center at Salisbury. This is an aerial view, and like most malls, we're at the intersection of two highways, lots of parking, high ceilings, loading docks associated with some of these empty anchor stores. The Macy's and the Sears, the former Macy's and the former Sears, the total is 100,000 square feet plus each. From an optimistic standpoint, it's a great time to reposition the mall. It's a great time to repurpose that space. It was acquired recently by a new group, and we're working with those to identify future opportunities in that retail sector. And that was a challenging sector prior to the pandemic, and a lot of e-commerce was driving that and accelerated that depressed retail market, especially in the malls across our country, and including our own here. We're not a large office market here, but you can bet when companies bring employees back, they will give them more options to work remotely, give them more options to telecommute. And why not? We're better at it. We're more sophisticated at it. We've had a year's practice. We're doing this Zoom all across the country. We have hundreds of people joining us all across the country. I bet next year when SVN does its conference, I bet it will include a streaming option of some sort. And your other conferences will likely do the same thing. I understand this is a commercial real estate forum, but I want to talk a little bit about the residential component too, because it's very complementary to where we are in the economic cycle, and it's very complementary to the commercial sector. I'll show you a chart of single-family housing construction in Wicomico County since January of 1995. The black line is a 12-month moving average. And so what it's telling us is we were building 25 and 30 homes every single month until the recession in 2006, 2007, 2008. And it just stopped, and it went down to 4 and 5 or 2 or 3. And they were custom built homes that likely would have been built anyway. Very subdued activity since the Great Recession. Part of that is working off the excess leading up to the recession. Part of that is Maryland strengthened its regulatory environment during this period of time. But for whatever reason, we were not building a whole lot of single family homes. That's changed in the past 6 months, 7 or 8 months. Drive through almost any residential development that has water and sewer service in Salisbury or Fruitland or Del Mar and some of the other municipalities, and you'll see an enormous amount of single family construction happening right now. And subdivisions that once had dormant lots, they are underdeveloped now, they're under construction now. And it's important to create that product. Is that if one side of the coin of economic development is to attract jobs in industry sectors for growth opportunities, then the other side is to attract residents to our area. And even then, that's not good enough. Even then, you want to have that product for them to purchase. Because if they purchase product here, they live here. And it's important, number one, because you tax people based on where they live. Number two, it's probably the best thing we can do to fill some of this commercial and retail space, is to have more people living here. And number three, it creates a lot of jobs. It takes a lot of people to build a house. In Wicomico County, the construction sector and the professional business services sector account for about 15% of all of our jobs in the county. The construction, these are your your contractors, your wall trimmers, your pavers, your masons, your plumbers, HVAC, roofers, professional business services sector. These are your architects and engineers and surveyors and paralegals, mortgage brokers, title companies, real estate people, all tied to a very strong and vibrant residential market. So while we're building a lot of single family homes right now, the market is even greater. We have less than 200 existing homes on the market, an absorption rate of about 1.5 months. And typically you want to get in that 4-month range, 5-month, which would equal 400 or 500 homes. So it's an important component going forward. It's an important part of our economic development. And so as we move forward, for us, we want to continue to target those economic sectors that provide a platform for future growth, like the microwave sector, like the poultry sector, like the life science sector. And entrepreneurship, and Wes alluded to it earlier, that's a key component to doing just that, along with utilizing the assets that we already have, those assets that differentiate us from other communities, like a port or an airport and others. But the entrepreneurship is important. I can trace the roots of our poultry industry back to the founding of one company by Mr. Perdue 100 years ago. I can trace the microwave sector back to the founding of one company in the early 1970s by one entrepreneur. And the same thing with our life science, which today employs hundreds of people in Wicomico County. So identifying those key future economic sectors is important. 2, create more industrial space, not just for today. It's hot today, and markets, and we've been around long enough, markets goes up and they go down, but create that space in an orderly way for the future for an industrial sector. It may be repurposing existing space, it may be building new. And 3rd, let's create that environment where people want to be. Let's create those subdivisions so when people choose to live here, they have a product to purchase. I appreciate the invitation today. I will yield to the questions. I know we have a number of questions coming in the box, and I'll back to Wes to field those if I can. Thanks for having me, and it's a great time to invest in Salisbury.
Dave, great job, man. Great job. I can tell you, I, like the rest of you folks on the call, have probably been on over 100 Zoom calls in the last year, and you're probably the best Zoomer that I've seen in switching back and forth between slides and sharing your screen. I tell you what, man, you've really become a pro at this. So
we have a lot of practice.
yes, you have. You fine-tuned it. So we do have a couple questions before we introduce our next speaker. We'll get them real quick. Todd asked a question: do we have an average per square foot price for property sold? Todd, yes, we can get that to you. Just let me know which property type you're referring to. It's not going to do much good to give you an average price for all property types combined. I guess you're probably referring to medical or industrial space. So get that over to us, Todd. Bill had a question for us. Any major differences between the 3 counties in sales and sold activity? Bill, great question. Thanks for bringing that up, because this report that Brent introduced, this is our 2020 market report. This covers exactly those answers. And I'll just give you the kind of the snapshot for those that are also interested really quickly. Wicomico County, 93 transactions, average sale transaction was around $1.4 million. Worcester County, 73 transactions, so 20 less than Wicomico County. Average sale price was also around $1.4 million. And then Somerset, of course, would be a little bit lower than that. And rather than flip through pages, we'll get you this report. So great question, Bill. We do have all that information ready for you. Dave, I do have a question for you, really quick though. Where does the progress to build the windmill farm stand off the coast of Ocean City, and how will that affect manufacturing and other industries on the lower shore in the short and long term?
Yeah, I'm not sure where exactly the politics of it are in the regulatory environment, but it's coming our way. And we've been talking about this for about 7, 8, 9 years now. And the supply chain is already here. They've already been connected to a lot of those original equipment manufacturers, GE and the like. We've started a training program here and through Archon Welding and their training school. that we're training people in offshore wind by training people with onshore wind and windmills today. So we think there's a lot of opportunity, especially in Wicomico, for the training component to that. There will be a maintenance operation located in Ocean City, Maryland, which is terrific for our region too. So we know it's coming, and we think there's it adds, I think, the most important is it adds another economic sector to our community. You know, again, you look at poultry, you look at microwave technology, you look at life science, you look at the institutional entities we have. And then the more we can create those new economic sectors, the more diverse our economy is, the more resilient we are, and the better we withstand any disruption, whatever comes our way in the future. So I think it's an important component too, and that's not going to be the end of it. We're going to have additional economic sectors the next 5 or 10 years.
Yeah, Dave, just to add on to that, hope I don't reiterate anything that you just said. Hopefully that spurs some new construction, new development in industrial space. And with Wicomico County and Salisbury being the hub of that industrial market, it really could use some new product online. And of course, we have great industrial parks to do so. So moving on, we got to keep right on schedule. We're going to go ahead and get right into our next speaker. Next speaker is Kevin Giacomo. Kevin's a friend of our office. We've known Kevin for over 13 years now. And Kevin is now the president and CEO of SVN International. Keeping his bio short, probably one of the more impressive things on his resume is that when he started with SVN, he led the company from 7 offices in 2001 to now today we have over 230 offices. So Kevin's done a phenomenal job leading our company. His leadership's been instrumental in the growth that we've all experienced. So Kevin, go ahead, man. It's your floor.
Thank you, Wesley, Brent. And I'm just going to operate with 2 screens. So if you could just verify that you can see the slide on the screen there.
We're good.
Okay. Let's dig in here. So thank you. It's really a pleasure to be with you here this morning. Kudos to SVN Miller. Kudos to Salisbury University for producing an event of this sort, of this caliber. Thank you sincerely for doing this. I think it's an important initiative. As Wesley said, excuse me, I'm the CEO of SVN International, right? So we're a full service commercial real estate advisory. And in terms of my view of the world, to sort of set the pretense for the comments that I'll issue, we operate in more than 500 markets in 8 countries. And then within that umbrella, more than 15 product types are practiced under the brand. And so our industry and our market coverage are highly diversified. And I say this only because my domain in SVN as a whole extends well beyond the Eastern Shore, is more macro level in nature. And that's the extent to which I'll issue my comments today. And some of my thoughts listening to David, listening to Wesley, listening to Brent will mirror those that have already been issued, but I think they do bear repeating. So please bear with me. The other thing that I always say when I deliver talks like this is that I'm not an economist. It's not what I do. I run SVN, but of course I do closely watch, and I am a student of the political and economic underpinnings of the commercial real estate market. And so my thoughts will be pragmatic in nature. There's certainly some negative in there, and I'm not going to be positive for the sake of being positive. That said, and to sort of give you the punchline, I feel really good about where we are as an industry and with respect to both the positive momentum that we're seeing at SVN and the emerging real estate investment opportunities stemming from this crisis that the market is talking about. But let's start by thinking about and taking a look at the calendar. So almost to this day, 1 year ago, 8 governors across the United States took the initial move to close bars and restaurants, and grocery store shelves were quickly emptied out. And Wesley, Brent, and his team and I were returning from our last annual conference in Palm Springs, California. And it was an upsetting time, to say the least. So economically, the Dow posted its largest one-day drop ever, finishing down a record close to 3,000 points. And the world, as we know it, was hitting the proverbial fan. new incoming information at the time, none of which was encouraging, came across our screens at a frantic, frenetic pace, causing our stomachs to turn and our portfolios to sort of drop in tandem. Now, with a full year now passed by in the COVID economy, the universe of uncertainty has thankfully compressed. And while it was not an advanced degree that any of us had sort of applied for, the pandemic has imparted a lifetime of lessons offering clear clues about the future of commercial real estate, the future of office space demand, and the ways that we as humans interact with the built environment. So let's zoom way out and start first with the economy as a whole. And again, let's level set here before we dig into where the market is headed and the factors that we have to contend with as we plow forward. Now, again, I'm reticent to do this, but it's important. And I know that we've all become a bit numb to sideways numbers during the past year, but to dig ourselves out of the hole, it's important to understand just how deep we were in the hole. So early last year, while we're all still finishing our champagne and settling in after the holiday season, the Congressional Budget Office released its estimates of 2020 economic growth. So serving as sort of a reliable benchmark of where the economy would have stood without the pandemic. Back then, it was where they think the economy was headed. Actual output last year fell short of the CBO's early 2020 forecast by over $1 trillion. And to put that into perspective, that's good for an average loss of about $3,500 for every American. So more workers filed for unemployment claims in the first 9 months of this crisis than they had at any time during the entirety of the 07-09 recession, and the unemployment rate hit, as you can see on the screen, a stratospheric high of close to 15% last April. David talked about this on the local level. Present day, we see ample signs of growth, of recovery. According to the most recent jobs report, the civilian unemployment rate ticked down 6.2% through February as the economy added back some 379,000 jobs. So we remain a long way to go, but between vaccination rollout and the onset of warmer weather, the W-shaped recession, we're seeing pretty clear indicators of our being on the road to recovery. There exists a plethora of themes, of factors which speak to the influence of the commercial real estate market in 2021 and vice versa. And I'll touch on a few now, and I'll speak to most of them in greater detail a bit further down the line. The first thing to consider and acknowledge, and we've heard some of that on our call so far, is that our theories and our guesses as to the impact that COVID-19 will have on commercial real estate are going to become clearer and more pronounced in the near term. We're going to gain some clarity very soon here, and that's a good thing. Not all good news, but clarity is an important facet of a recovering market. There'll also be clear asset class winners. That's another theme, and we expect that transaction volume, sales volume, leasing activity in favorable sectors like industrial will meaningfully outpace those more troubled categories like retail. Another trend that we've talked about this morning is that work from home will continue. And as a result, the trend of adding square footage to the office market, adding supply to the office market, should continue at least through 2021. And then there's the suburban growth trend. The suburbs are cool again. And COVID's accelerating suburban growth, especially in the Sunbelt markets. And then on the flip side, major cities are expected to see a population decline. And there are wonderful investment opportunities with respect to both of these opportunities. We talked about this earlier. So let's now drill down and look at the impact that these trends are having on the primary food groups that we focus on at SVN with respect to the asset classes of apartments, office, industrial, and lastly, retail. And we'll start with multifamily. So an often peddled reframe during the early days of the pandemic, March, April, May, was that the multifamily and apartment sector as a whole would maintain its stability by the simple fact that people will always need somewhere to live. And that sounds eerily like the mortgage crisis and some of the comments that were issued back then. But if anything, the same optimists argued that the resiliency of cash flows stemming from apartments could actually improve as renters were spending more time in their homes due to involuntary quarantines. Again, we're gaining clarity now. We're gaining clarity here with a year of data available now supplanting conjecture. We find that residential rentals have indeed performed up to expectations. Conditions haven't been ideal, and distress is not too hard to find, distressed apartments, especially in primary gateway major markets. But compared to worst case scenarios, the apartment sector has lived up to its reliable sort of bedrock status. It did what we thought it would do, which is good news. In terms of what to watch for in the apartment sector, at SVN, we're paying close attention to rent payment trackers. We're paying close attention to the eviction moratorium and COVID-induced migration from primary coastal markets. A benefit to some as there's a flight from major cities to rural America, a hit to others depending on the geographic focus of an investor. But on the screen in front of you, and I took a bit of time digressing there, and I apologize. In terms of timely rent payments, according to the National Multifamily Housing Council's rent tracker, 93.5% of renter households paid rent on time in February. And that's only a 1.5% drop from the same month a year earlier. One challenge that we face is controversial in nature. The CDC's eviction moratorium remains a pressing challenge for the industry. We don't talk about it a lot, but from the inside, it's a problem. It's a detriment to our ecosystem. And we say this because it harms renters. It harms the marketplace. It's not healthy legislation. The market for rental housing is a circular flowing ecosystem between lenders, investors, renters. There's no net positive corrective policy that achieves more benefit than harm by breaking that symbiotic process, much as the moratoriums have. So that has added some stress to an otherwise healthy and resilient product type, although we can understand and intellectualize and appreciate the moratorium. It does remain in place, but at the end of this month, the moratorium's scheduled to expire. You read what I read. The appropriations bill passed at the end of last year. The stimulus plan passed last week, collectively set aside, just to put it in perspective and bring it home into what we do, the commercial real estate sector. It set aside close to $50 billion for rental assistance programs, which does bode well for all phases of the apartment ecosystem. Let me just touch on migration from major markets because David so eloquently framed the issue and the opportunity. It is something to pay attention to. There is a clear trend in place, and to put it into perspective, the trifecta, right, of New York, California, and Illinois, the states that are home to the three largest cities in the United States, collectively lost more than 275,000 residents in 2020. 275,000 residents in 2020. So the human density that has historically attracted demand towards, these superstar cities has had the complete opposite effect in the last year. And I think this makes sense. Without accessible cultural amenities or the need to be in an office Monday through Friday, a significant share of the workplace became untethered to their home cities and have made their way towards the city's exits. And watching how this group behaves as large companies start calling workers back into the office and cities start to look more like their pre-pandemic selves is going to be very important and very telling. Let's talk about office. Office, no property type more subject to speculation than office. So unlike multifamily, retail, industrial, where COVID has mostly magnified pre-existing trends that were already in motion, the pandemic has led to rampant reimagination of the office sector. So our understanding of how both firms and workers interact with their physical office environment to to optimize productivity, I think has permanently changed. So simply put, over the last year, the American workforce traded commutes for what we're doing here, for Zoom links. And this has been an illuminating natural experience that challenged the office sector's core assumptions. And I can recall reading PwC's remote work survey last June, where 44% of employees thought that the transition to remote work has allowed their teams to be more productive than before the pandemic, when the same employers were polled again in December, the share climbed to almost 60%, indicating that not only has a consensus emerged, but that efficiency has improved following the initial curve. As David said, we're getting better at it. We're becoming more efficient. So, we haven't hit a no turning back Pandora's box type of moment, but the view that CEOs have that I speak with are that 5 full days in the office is not required. So beneficiaries of these trends can be found in some of the smaller markets. Those who are benefiting from the impact of major market migration, those hit hardest are obviously in the larger markets. And overall, let's zoom out and look at the office sector for what it is. The likelihood that total office space demand will have a smaller footprint in the post-pandemic world is a consideration that we can't afford to take lightly. Now, on the flip side, fatigue, the desire for socialization, the desire for collaboration are going to pull workers back into the office. So not all metro level office markets will move in the same direction. Some of the migratory demand that's leaving those large cities and contributing to localized weakness will lead to strengths in other markets, particularly, in our opinion, in major market adjacent suburbs. So just some data for you, according to Real Capital Analytics, CBD office properties posted a 0.2% decline for the year. On the other hand, suburban office assets saw valuations continuing to grow at a healthy 6.6%. So a very positive sign for this audience, I think. Let's move over and talk about industrial as we walk through the food groups and wrap up here. It remained the undisputed top performer of commercial real estate in an otherwise challenging 2020, without a doubt. Secular tailwinds, propelling its growth, like e-commerce's adoption, grew from a healthy sort of gust to a sustained hurricane force. So over the past decade, online sales have increased by an average of 15% annually. And on the flip side, brick and mortar sales over the same period have only grown by an average of 3.4% per year. So to no one's surprise, the share of total retail sales satisfied by online orders has steadily risen. And the pandemic has permanently transitioned some in-person retailing onto online platforms, obviously. Online grocery stores, online delivery services, grocery delivery services, which is a concept that sort of faced greater consumer resistance than other e-platforms before 2020, stood uniquely positioned to benefit from the demands of a lockdown economy, and it did. So what does this mean? Well, surging demand for e-grocers means an increased demand for distribution and fulfillment facilities in close proximity to consumers. And to many at SVN and beyond, it should come as no surprise that we rank fulfillment facilities as a subsector with the best prospect for future investment and development opportunities. It's a great space to be in right now. And then another news source for industrial demand can be traced to supply chain disruptions experienced this past year, which bodes well for B and C markets, some of the smaller markets. So the pandemic exposed some critical sensitivities, and e-commerce retailers are looking to better safeguard their ability to match inventory supply with order demand. And doing so has meant a transition from just-in-time distribution models in favor of what we call just-in-case distribution models. And the latter requires excess warehousing space to stock contingent inventory, which bodes well for both the sector and your local market. Let's move over and talk about retail, which is a fun topic. And we really just talked about much of this. There was no shortage of pessimism surrounding the retail sector heading into 2020, even before there was a pandemic to contend with. Retail was facing several headwinds going into 2020. One was that we had a retail supply problem with more retail space per capita, more retail square footage per capita than any other country in the world. Another factor was online shopping, which we just talked about. And this meant that brands that were on the path towards obsolescence, ones that we suspected were on borrowed time, were those that struggled the most during COVID, and none more so than department store retailers. And just to sum it up for you, without going into detail, as much as this is painful, I do have to say that this acceleration of trends that we noticed prior to COVID and 2020's pain with respect to the retail sector will help it pave a quicker path back to recovery. So the sector's gone from Darwinism to Darwinism on steroids. Though before we can imagine, a radical future where physical demand sits just a bit higher than supply, the existing glut of obsolescent space needs to find adaptive reuse. And one of the challenges associated with that is that not every struggling mall will be turned into an Amazon distribution center. That said, we're seeing some excellent repositioning buying opportunities, lifestyle centers where fitness centers, housing units, and mixed retail are blended together are one of the leading concepts to aid in repositioning and reabsorption as we move forward through this retail cycle. And in the near term, we think we'll see a retail pop and a reversion back to some semblance of normalcy, and that'll provide retailers with some much needed relief. So to sum it all up, whether it be on the public health front, the economy, commercial real estate, or our lives in general, or how all of the above are inexorably tied, 2021 has, in our opinion, all the makings of a year defined by recovery. Michigan's consumer confidence survey just released yesterday or the day before rose to 83%. And overall macro level data indicates strong growth in consumer spending during the year ahead. And if anything, there's a lot of chatter, and there's certainly some increasing concern that the economy has the potential to actually overheat in the near term as too much fuel enters the fire all at once. And in fact, the March iteration of the Wall Street Journal's economic forecasting survey says that the newly passed stimulus will generate inflation higher than the Fed's 2% target. And that's a factor to consider as you think through your own real estate strategies. One last slide here. And this chart just came across my desk last night. This is the January Real Capital Analytics CPPI report. And it shows some healthy valuation growth, which was a pleasant surprise. So the CPPI is just a commercial real estate price index. It rose 7% in January, climbing back near the growth rates seen for much of the 2019 pre-COVID era. And this, by the way, is macro level data, so not the unhealthy pricing appreciation concerns that Wesley referenced may exist locally. Office prices rebounded by more than 3% in January. The industrial sector grew by over 8% in January. Multifamily's up by 7%, a plethora of leading indicators for a strong rebound. But again, to be clear, to be candid, in many ways, we as an industry, all of us in this virtual audience, remain in wait and see mode with questions over returning to the office and its associated timing and right sizing are still sort of swirling overhead. I'd be remiss if I didn't say that overly conservative and reactive strategies rarely make winning formulas in commercial real estate. And deals are abound. As with any economic downturn, investment opportunities arise, and they are here. So case in point, at SVN, we're on the heels of our most active year in company history in terms of sales volume. We're on the heels of our best December in terms of number of transactions. And my point is that deals are happening. Now's the time for real estate practitioners to take a more holistic view of their real estate exposure, of their portfolios, and then execute a strategy. And if 2020 has taught us, nothing else, it's that the pace of change can accelerate quickly, and watch for that as the calendar turns. Falling behind the curve of innovation is a costly and often uncorrectable mistake. Thanks, guys.
Kevin, thanks so much, man. Great outlook on everything. Just to reiterate, Kevin looked at a real big macro approach, and what Brett and I did, we focus a lot on the very micro approach as I identified just on the lower eastern shore. Kevin and Dave brought up a topic more than once, so I'm just going to touch on it real quickly again, and that was the migration from major markets. The reason that plays a big role for us on the eastern shore is we're, of course, not a major market. So we're what we call a tertiary market, and we've already seen explosive growth in Sussex County, our neighbor to the north, just a few miles, which Dave touched on with the new construction. They've seen about 3,000 new homes built every year for like the last 10 years. So that trend is going to amplify even further as we continue to see this migration, which is going to put a further demand on all the services, commercial real estate, just to meet all the new population that's coming in. And it's not just baby boomers like it was in Sussex County before. It's now a lot more than that with a much more diverse age group. So just a key point to take away for us here locally and keep an eye on. So moving right along, we're right on schedule. Now Mike Truitt. Mike Truitt is Senior Investment Advisor, Managing Director here at the Merrill Lynch office in Salisbury, Maryland. Mike's going to introduce our next speaker.
Thank you, Wes. Thank you, Amy. Thank you, Brent. Thank you, Amber. Thank you, everyone. Kevin, that was great. I'm glad I don't really have to follow that act. I just have to introduce the next speaker. So that was very educational. Thank you very much. As Wes said, I'm Mike Truitt, Vice President, Merrill Lynch in Salisbury. I just want to say thanks for having us. I want to shout out to Patrick Sears, my partner. Patrick's on board with us. And I just want to give a little background on our partnership with Blackstone Group. So Bank of America is the second largest bank in America with 2.5 trillion in assets. We basically, Merrill Lynch is a wholly owned subsidiary of Bank of America, and we're the second largest wealth management firm in America. So we're pretty selective about who we partner with. And Blackstone is, one of the largest private equity firms in America. They manage more than $600 billion in assets for institutional and retail investors. And we're really excited to have AJ joining us today. His topic will be real estate investing through the lens of the pandemic. So just a quick little background on AJ. He is a senior managing director in the real estate group where he focuses on the global core plus business and serves as director and president of the Blackstone Real Estate Income Trust. Prior to the launch of the core plus business, AJ was previously a co-head of the U.S. acquisitions team and oversaw more than 50 billion of investment transactions across all real estate classes. In addition, he's led two successful initial public offerings of stocks, what we call IPOs. The 2013 IPO of the Brixmor Property Group, which is a publicly traded REIT, real estate investment trust, trades on the New York Stock Exchange under the ticker symbol BRX and has a current market value of $6.3 billion. AJ also oversaw the 2013 IPO for Extended Stay Hotels, which trades on the NASDAQ under the ticker symbol STAY and has a current market value of $3.4 billion. AJ was also directly involved with Blackstone's investment in General Growth Properties, a name that may ring a bell with a lot of you on the call, which is another publicly traded REIT, which is the second largest shopping center mall operator in the United States. I could go on forever, but you get the picture. AJ Agarwal is a national leader in the commercial real estate market and is eminently qualified to share his thoughts with us today. AJ graduated from Princeton University, where he graduated magna cum laude and Phi Beta Kappa. He went on to receive his MBA from Stanford University and joined Blackstone in 1992. So on behalf of Merrill Lynch, Bank of America, Patrick Sears, and everyone on the call, AJ, thank you so much. Are you joining us from downtown Park Avenue, or are you at home?
Mike, thank you for having me here today with your clients, and I'm joining you from our Manhattan office, Midtown Manhattan, Park Avenue.
Great. Well, the floor is yours. Take it away.
Thank you so much. And I'm looking forward to the discussion today on U.S. real estate markets. I didn't get a chance to listen to the full presentation by Kevin, and I know if I express some views that are different from his, we can cover that in Q&A. But my colleague, Eddie Burnson, is going to be leading, I think, a Q&A discussion here. So I'm going to turn it back to him.
Thanks, AJ, and thanks, Mike. Again, my name is Eddie Burnson. I work in Blackstone's private wealth arm. So working with individual investors and family offices, small institutions. Just a bit of history, we're now a $600 billion firm. Real estate's the largest of that group, managing over $150 billion in investor capital. For about 25 years, it was really only working with the big pension plans, the public pension plans, corporate, sovereign wealth funds, foundation endowments, and now we're managing over 100 billion in individual investor assets. So that's the work group I sit in, and one of our best partners at Blackstone is AJ. So I'm gonna lead a little fireside chat here, and then we'll open it up for some Q&A. So AJ, thanks for joining us. To start out, what's the case for investing in private real estate today with such a fascinating and, I guess, unique macro backdrop?
Thanks, Eddie. Again, looking forward to our discussion, our fireside chat. So your first question is, what's the case for investing today in private real estate? I'm going to outline what I think is a fairly simple rationale, and I'm going to do it from the perspective of investors. When I put myself in the shoes of investors today, I struggle, like others, to find durable income in today's low-yielding investment environment. And when I talk to investors, I hear this as a refrain. They're struggling from their bond portfolios to see how they can actually generate yields. And in fact, many of them are facing a situation where they're seeing negative real yields as inflation here moves up in the US. And the simple answer is private real estate can answer this problem. When you think about what private real estate is, it's a 95% occupied apartment complex, or it's an Amazon leased warehouse asset. These are assets where the tenants pay rent, and that rent then gets distributed out to investors as regular income. And this apartment and warehouse income is steady and reliable over time through cycles and market dislocations, including, by the way, last year during COVID. I saw that you put up a slide on the screen. What this slide shows is the amount of income that private real estate has generated over the last 20 years. And over the last 20 years, private real estate has distributed at least a 4% income yield in every year but one. So in a world today where it's really hard to find yield anywhere, private real estate can generate consistent income. It's attractive income, it's compelling income, and I think it's the simple case for adding, private real estate to investor portfolios today, particularly when that private real estate is, and I heard the end part of Kevin's comments, particularly when that private real estate is in asset classes that are on the winning side of long-term macro trends, like suburban apartments or like warehouses, as opposed to, for example, shopping malls.
Excellent. That totally makes sense on the income side. What about appreciation? What ability is that to obtain as an individual or institutional investor in commercial real estate for appreciation focus?
Yeah, well, private real estate offers appreciation potential as well. And this is why real estate's actually sometimes called a hybrid asset. And by hybrid, I mean it has income components like a bond, and that we just talked about the income potential from private real estate, but it also has long-term appreciation or value appreciation potential, like with stocks. And just like with stocks, appreciation can come from two sources. It can come from earnings growth, and it can come from multiple expansion. On earnings growth, going back to that Amazon leased warehouse example that I spoke about earlier, If we have a lease with Amazon, you should think about it as a lease that's 3 to 5 years. And that lease has what we call contractual rent escalations. The rent that Amazon pays us this year is higher than the rent that they paid us last year. And this earnings growth and this cash flow growth is one of the ways that you get real estate value appreciation over time from earnings growth. Now, with regards to multiple appreciation, it's a little bit more nuanced, but let me explain to you what we're seeing here at Blackstone today that can lead to multiple expansion in real estate. So if we all are macro observers of the US economy and take a step up, today we have the benefit of the US economy from about $5 trillion of stimulus money, including the most recent $1.9 trillion of stimulus. And this money has been injected into the US economy, and this money, this flood of money, has to go someplace. And what you've seen to date is that it's gone into bonds and bond funds, it's gone into equity and equity funds, and it's pushed the yield of bonds and equities down, and it's pushed the values of bonds and equities up. Now, interestingly, as the 10-year Treasury has dropped from around 3% in 2018 to about half that today, about 1.5% today, what you see on this slide that you put up here, Eddie, is that real estate yields or real estate cap rates during the same time period when the 10-year Treasury is halved has been relatively constant over the last year, 2 years, or 3 years. You can see on the slide on the screen that the unlevered yield or cap rate for real estate in the major sectors like office, retail, multifamily, and industrial has hovered around 5 to 5.5%. And so with rates having come down, with real estate yields having stayed constant, we are now at a point where there's a relatively wide spread between real estate cap rates and interest rates. And that's what you can see on the far right side, something between 400, 450 basis points of spread between what you can earn when you buy real estate and what you can earn when you own, for example, risk-free. So when you think about that yield of real estate around 5%, that's like 3 or 4 times the rate that you can earn on a 10-year Treasury yield. And that just hasn't happened before in history. So our view is that, again, as investors globally here in the United States hunt for yield as they look at real estate as a relatively attractive source of consistent yield, we're going to actually see capital flow into private real estate. We're going to see cap rates compress like we've seen in bonds over the last year. And that's the case for some upside or value appreciation coming from multiple appreciation on the real estate side. And again, we in particular believe that this cap rate compression potential exists in the asset classes where people have more confidence about the durability of income, the likelihood of that income growing over time. And that's more, again, from suburban apartments, warehouse assets, net leased assets, maybe self-storage assets. Certainly not as much confidence, for example, in traditional malls, as an example.
That's fascinating. And so if rates, then start to go the other way, which we've seen starting to happen. So rates rising, inflation coming into play with all the stimulus and the potential for bigger GDP gains. What would that do to commercial real estate? And what's Blackstone and your thoughts on that?
So the inflation question, which is I think what you're asking, Eddie, has definitely become a more popular topic over the last couple of months as concerns about the quantum of stimulus being injected into the US economy, potentially leading to an overheating, temporary or permanent, of the economy, has led to this discussion about inflation. So let me start by saying that real estate is a hard asset class, which actually has fared typically well in inflationary environments. And there's a simple reason that's intuitive to understand why real estate has performed well in inflationary environments. And that is that real estate rents, the amount of rents that we can charge to tenants, like apartment tenants or warehouse tenants like apartments, those rents generally increase when we're in an inflationary environment. If US stimulus spending leads to the economy doing well, that's when prices are increasing, and that's when you have inflation. But it also means that the economy is doing well, corporate profits are going up, wages are going up, and we as landlords can actually charge a little bit more to renters of apartments or renters of warehouse assets. And thus the income that we earn from real estate is not static. It's not fixed. It's not like fixed income. It actually increases over time, certainly with inflation. And so that means that real estate assets can keep pace with inflationary trends, actually increase rents generally faster than inflation. And it's usually a good hedge to inflation, certainly relative to, for example, fixed income or bonds in an inflationary market.
AJ, can you please discuss why sector selection matters so much in real estate investing and the most favorable sectors that you're seeing today?
Yeah, and by the way, as I mentioned, I picked up on the last couple of minutes of Kevin's presentation, and what I gleaned from his comments were that, yes, COVID has affected different real estate asset classes differently. It's absolutely the case, but what we have seen at Blackstone in investing over the last 30 years is that at different points in time, it's more attractive to invest in certain asset classes or certain geographies than others. We are big believers in thematic investing and focusing our investing on asset classes that are benefiting from what we see to be long-term macro positive trends. So picking up what Kevin said, think warehouses over malls. Think suburban apartments maybe over in the midterm urban apartments. And that's why, today, and you made reference to a Blackstone private REIT called BREIT that I oversee. At BREIT, our portfolio is heavily invested in these sectors that we see benefiting from long-term macro trends, warehouses, multifamily, net leased assets. By the way, each of these asset classes had stable or growing cash flows even during COVID, even during the last year, which gives you an idea of how different asset classes perform differently in downturns. So let me just share with you, as you have up on the screen, the rationale for our focus here at Blackstone on two of those three asset classes that you have on the screen. First, I want to talk about why we believe in multifamily investing, and the second we'll cover warehouse investing today. So in multifamily, and I'm going to use, when I describe these two asset classes and why we believe, a framework of what I call supply and demand. Generally at Blackstone, we're interested in investing in real estate asset classes where the demand for that real estate asset class is growing faster than the new construction or new supply of that asset class. And that's super intuitive. When demand is growing faster than supply, occupancy is moving up, rents are moving up, cash flows are moving up. When you have the inverse, supply is growing faster than demand, you actually have rents coming down, occupancy coming down, cash flows coming down. So in multifamily, this is really a supply, or actually undersupply story. And we see in here in the United States, chronic undersupply of US housing, leading to strong multifamily fundamentals. Less new supply of apartments means higher apartment occupancies, means higher apartment rents. Specifically, when you look on the left-hand side of the slide that you have up on the screen, today in the US, we're building approximately 20% less new housing than we were actually building in the 10 years before the global financial crisis. Even though the population of the United States today has never been higher. And this supply-demand imbalance is especially notable in suburban Sunbelt markets like Phoenix or Jacksonville, Raleigh, Atlanta, Dallas, where, for example, at Blackstone, we're heavily invested. As a result, what you can see in the markets where we're investing because of this supply-demand imbalance, multifamily or apartment occupancies, 94, 95%, have been very stable over time, even during COVID. And when we turn to the warehouse story, and Kevin covered some of this, the story is super simple. E-commerce growth, buying stuff online, is driving US industrial fundamentals. What we see is growing e-commerce spend and penetration is leading to higher warehouse occupancies, lower warehouse vacancies, and increasing warehouse rents that you see on the right side of the slide. In fact, COVID turbocharged the growth of e-commerce last year. E-commerce sales last year, as you can see on the left-hand side, spiked way up, grew about 60% year on year. And that led to a huge increase in demand for warehouse assets in the last year. And from our perspective, we don't see this migration to e-commerce shifting. We think that over the next 10 years, we're going to continue to see more penetration of e-commerce relative to traditional shopping. And that's going to drive over the next decade more and more warehouse demand. So let me close by saying that we believe strongly in sector selection, warehouses over malls, suburban apartments over urban apartments, suburban apartments over hotels. We believe in geographic market selection. I grew up in Milwaukee, Wisconsin. We don't own a lot of assets, if any, in Wisconsin, where there's been population that's been flat. We own assets more in growing population markets, growing employment markets. And we believe that asset class selection and market selection can drive alpha or outperformance. And one of the statistics I tell you is that we run a very large private REIT that is distributed through Merrill, and that private REIT, since we started that REIT, has generated 9% net returns. If you were to invest just in the U.S. REIT index, you would have earned about half of that return. That's 400 or 500 basis points of alpha over the course of about 5 years annually. So I think by selecting the right asset classes that are benefiting from long-term macro trends, you can actually generate long-term value appreciation.
Thanks, AJ. What specific challenges have you seen out there in this current macroeconomic backdrop?
Well, and Kevin made reference to this, not all asset classes benefited equally from the last year. Obviously, with COVID and the slowdown of the US economy, it negatively impacted some real estate asset classes. Fortunately, as you can see on this pie chart, which represents what we own inside of our flagship income-oriented vehicle called BREIT, what you can see on this pie chart is that Blackstone's focus has been on multifamily, on industrial and net leased assets. Self-storage, it accounts for about 90-95% of our portfolio. But we do own small allocations of asset classes that were not beneficiaries last year of what happened with COVID. COVID reduced travel last year, which negatively impacted the hotel sector and retail, particularly even grocery anchored shopping centers, but certainly enclosed malls, were facing secular challenges even before COVID. And then because of COVID, we took another hit to retail last year as some shopping centers were closed and some smaller tenants at these shopping centers closed their businesses. Of course, retail is less than 2% of our portfolio, and it's all grocery anchored shopping centers. But also, for example, and the last comments that Kevin made, COVID has raised questions and work from home has raised questions about the future of office assets. We own about 1,400 assets inside of our non-listed REIT. 2 of those are office assets, and both of those are corporate headquarters buildings with long-term leases with, as I talked about, escalators. So the office question is open, I think, in terms of what's the timing of recovery. For us in our non-listed REIT, it's not a material issue given that we only own 2 out of our roughly 1,400 assets. But I would say, again, that not all real estate asset classes are created equal. Not all real estate asset classes will grow the same amount, for example, in 2021 or forward. We definitely like investing where we have macro trends at our back. I liken it to swimming downstream as opposed to swimming upstream. And we continue to believe when you think about these big categories, suburban apartments, warehouses benefiting from e-commerce, net leased assets that benefit from long-term corporate guarantees, self-storage that continues to be benefiting from people in the country moving around. We continue to have confidence that the income and appreciation potential in these asset classes is very, very attractive.
As we shift to the Blackstone real estate platform, can you walk us through some more details of our private non-traded REIT, BREIT, and how the portfolio is uniquely positioned?
Yeah, so I've made reference to BREIT. Let me step back and say BREIT stands for Blackstone Real Estate Income Trust. And it's a flagship Blackstone real estate fund. It's in fact one of the largest funds here at Blackstone across all of our businesses. And the design of BREIT is to bring the strengths of Blackstone's real estate investment management platform to high net worth investors, not just institutional investors. We launched BREIT about 5 years ago, and BREIT, as you can see on the screen, invests in simple to understand assets. It invests in stabilized, income generating real estate in the top 50 US markets based on Blackstone's bottoms up thematic investing approach. And what's really special about BREIT is the structure of the BREIT fund. It is a structure that was designed to meet the needs and wants of individual investors. We offer monthly liquidity, an ability to subscribe to the fund monthly and an ability to redeem from the fund monthly. So much more liquid than our customary closed-end funds for institutional investors here at Blackstone. We offer monthly income distributions. We've been generating about a 5% dividend distribution annually since we started the fund, and investors can receive that attractive tax-efficient dividend distribution on a monthly basis. We offer it as a 1099 as opposed to a K1, so it's simplified tax reporting. It's a fully drawn fund, which means the moment you subscribe, the money's invested and you're immediately earning that dividend income. You don't have to wait 3 or 4 years to have the capital deployed. And I made reference to the tax efficiency, but individual investors care not only about their pre-tax returns, but sensibly they care about their after-tax returns. And I just want to comment that BREIT offers enormous tax efficiency because what we own is real estate. Real estate generates non-cash expense in the form of depreciation. That depreciation gets passed through to our investors, and essentially all of our BREIT dividend distributions of roughly 5% on capital is sheltered by this pass-through depreciation. What all that means is that our investors, for example, last year in 2020, received their about 5% dividend distribution completely tax-free. They don't need to pay any taxes on that dividend distribution. And if you were trying to find a fixed income portfolio to try to replace that 5% after-tax return, you'd need to find bonds that were yielding 7 or 8% just because they would be taxable, which obviously in this environment, is very difficult, if not impossible to do. And by the way, just to be clear on how this tax efficiency works, we pass through the depreciation that we earn on our underlying real estate assets. You see that on your 1099 as something called return of capital, ROC, R-O-C. Last year, 100% of our dividend distribution was sheltered by this ROC, return of capital. And the ROC lowers an investor's tax basis in the shares of BREIT. So if and when an investor sells their shares in BREIT, they will have a lower tax basis in the stock, but they'll pay a capital gain tax rate on that gain as opposed to an ordinary income tax rate that they have avoided paying by receiving the dividends tax-free. Look, and what you can see on this slide here, Eddie, is that BREIT is a large diversified portfolio. It's $20 billion of equity capital from our investors. It owns over $40 billion of real estate assets. It owns about 1,400 cash generating stabilized real estate assets. And you can see it's heavily focused or concentrated where we see the best long-term growth potential. Again, suburban apartments, warehouse assets benefiting from e-commerce, net leased assets where the rent BREIT earns is contractually guaranteed by big publicly traded corporations, self-storage assets. And again, from a geographic perspective, heavily weighted to what we think of as the southern and western parts of the US. Again, markets in the US that are benefiting from population and employment growth. Look, when you add it all up, I say the proof is in the pudding. And when you take a look, investors should care about performance. And frankly, we're a mission-driven organization here at Blackstone, and our mission is to generate for our institutional and our individual investors attractive returns. BREIT has generated since inception solid returns and distributions, about 9% net returns since we began running BREIT about 5 years ago. And we've been generating of that 9% return approximately a 5% dividend distribution. We've had 4 out of 4 profitable years of performance. In fact, we've had 45 out of 48 profitable months of performance. So it's the kind of consistency of income and appreciation that you'd expect from a large diversified pool of income generating US real estate assets. These Amazon leased warehouse assets or suburban apartments that we spoke about. So we've been very proud of the performance that we've been able to generate for our nearly 100,000 investors who've trusted us with over $20 billion of their equity capital.
Thank you so much, AJ, and thanks, Michael and Patrick and Wesley and Brent for having us. Mike and Patrick have been phenomenal partners to Blackstone, and I'll pass it back to you guys, or to actually maybe Wesley for Q&A.
Eddie, hey, thank you. AJ, great job. Mike, thanks for introducing and bringing AJ and Eddie to us today. We always like to have a diverse group of speakers and change it up, and you guys are certainly add to that mix. We haven't had a REIT on our call before or any of our live presentations, so it really was a pleasure. We do have some questions that have come in. Eddie, I don't know if you can also see the Q&A box. If you can, feel free to kind of sort through those, but I'm going to go ahead and ask them as they have come in. So, AJ, this comes from one of our top hospitality brokers within SVN. He first says, congrats on Blackstone's purchase of Extended Stay America. He wants to know, what's the plan this time around? And he references, from his recollection, the last time around was to improve the brand renovation or add renovations and expand unit numbers and then go public. So I guess this question is geared toward what's next.
Sure. Well, thank you for the question. We announced yesterday that Blackstone, through our opportunity fund, so not through our BREIT vehicle, will be taking Extended Stay of America, a publicly traded company, private in a $6 billion transaction. And as your question references, we've owned Extended Stay twice before. We acquired the business out of bankruptcy in 2010, just at the start of the economic recovery, hotel recovery after the global financial crisis. And we built the business in 2000, 2001, just after the dot-com bust. And we built the business, took it public, sold the business, and then repurchased it after the global financial crisis, as I referenced. So the first thing I would say is that we are obviously today more confident today than we were 6 months ago, 9 months ago, about where we are in the lodging cycle. We are avid data collectors. We own significant lodging assets outside of our private REIT. And what we've seen is steady recovery in the fundamentals. And by fundamentals, I mean occupancy levels and average daily rates and now cash flows in the hotel sector. And so just like in 2010, after the global financial crisis, we think that we have the benefit of macro trends behind us in terms of recovery in the US hotel sector. And then number two, although I don't want to get into too many forward leaning plans for the business, since we just announced that go private yesterday, haven't closed on the transaction, I would say that having owned the business now twice before, we have a view that not only is it a steady cash generator, but there's the potential through the franchise business to expand its footprint with newer assets and an ability to continue to improve, through revenue management tools, continue to improve the cash flow generating capability of the existing boxes.
Thanks, AJ. As I mentioned, that question was from one of our top hospitality brokers named Tom Ham. So Tom has this is all Tom does is hospitality sales and analyzes it. Actually, my team's sold a portfolio of 6 hotels, and first thing we did was bring Tom in. So he's the expert, one of our experts in our company. So a little different question here. This is coming from one of our inactive clients, Eric. He's local here in our market. Eric's also a financial advisor. His question is, can you speak to the differences and potential edge of investing in a private versus public REIT from a PM perspective? And second, generally speaking, in the private investment vehicles, how have NAVs fared compared to where they were a year ago?
Yeah, really good question. So in a private REIT, especially a REIT that would be managed by Blackstone, which is a very large, experienced real estate manager, I'd say there are a few advantages. First of all, and by the way, you can see that in the results. If you look last year, we generated, even during a COVID year, softness in the US economy, BREIT generated over a 6% net return. The US REIT index last year generated a minus 7.5% return. So just last year, we generated about 1,300 basis points of alpha. And the reason for that is that, we're making decisions here at Blackstone where we see the best growth potential. So instead of clients investing in one REIT, or for example, the REIT index, Blackstone is making those decisions about where to deploy capital, what sectors to go longer in, what sectors to avoid, what geographies to go longer in. The second thing I would say is that private REITs historically have been significantly less volatile than public REITs. If you look at what happened, for example, last year in March and April in the US public REIT market, the public REITs fell out of bed and lost about 40% of their market caps in just 60 days. You don't see that level of volatility in private REITs. And so for investors who don't want to have that kind of roller coaster ride, private REITs offer lower volatility. But the big advantage, I would tell you, is that when you buy, for example, a single public REIT, that public REIT's investing in a single asset class today and will only be investing in that single asset class going forward. Private REITs like BREIT have the ability to zig and zag where you see the best opportunities. And there are moments in time, for example, when it's a great time to be buying, for example, suburban apartment assets. But there are other times when it's a great time to be buying warehouse assets, particularly the last mile assets benefiting from e-commerce growth. There may be other times when it's a very attractive time to be owning hotel assets. And so we have the ability to go in and out of asset classes or geographies much more nimbly than a public REIT that's basically committed to investing only in, for example, office assets or only in shopping center assets. So when you put it all together, I'd say, again, proof in the pudding, performance, measure the performance of a diversified REIT like BREIT against what the US REIT index has generated. You can also take a look at the volatility. We've generated less than 1/3 of the volatility of the US REIT index. And I would also point out that from an income generating perspective, our REITs are very much focused on REITs that generate a lot of EBITDA minus CapEx, since we don't believe you can buy groceries with EBITDA, only buy groceries with EBITDA minus CapEx. And so our dividend yields are obviously also a little bit higher because we're focused on more cash generating real estate asset classes than the average public REIT.
AJ, you need to make that part of your sales pitch, that your REIT generated 1/3 less volatility than the other public REIT sector. That's a pretty good point that you threw out there.
Actually, 2/3 less, 1/3 of the level of volatility.
2/3 less. Yeah, thanks for clarifying. Absolutely. I mean, volatility has been a big thing, obviously, so that's a pretty cool point that you pointed out. We do have another question that's come in regarding the industrial sector portion of your portfolio. How much of that industrial portion of the portfolio is held in cold storage, meaning how much do you own in cold storage? And do you have plans to get more into that space?
Yeah, good question. Substantially all of our warehouse portfolio, which is about 150 million square feet of warehouse space, is in traditional last mile warehouse assets with a very small allocation to cold storage. And it's not to say that we don't think cold storage is an attractive asset class, but what I would say is that it is different from traditional warehouses So the traditional warehouse, particularly the last mile warehouse asset, is what an Amazon is using to actually move its goods from manufacturers of goods to ultimately your front door. They are in particular focused on assets that are located close to dense populations to make delivery times easier. Cold storage is generally used for food distribution to either grocery stores or restaurants. There's much more capital involved in running a cold storage facility because you have to have chilling capacity. And what I would tell you is that the depreciation on a chilling unit is it's over a shorter lifetime than the depreciation of the land and the building at a warehouse. And so a cold storage facility is a mixture of a warehouse, but it's also like a big freezer. And when you're an investor in warehouse assets, we like the fact that, frankly, warehouse assets depreciate at a very slow rate, but the chilling improvements in cold storage depreciate at a faster rate, which again just requires more capital expenditures. And as I mentioned to you, we're very focused on EBITDA minus CapEx, and traditional warehouse has a better free cash flow yield typically than cold storage. Both have very favorable macro trends right now. One just happens to have a little bit better of a free cash flow potential.
I have a follow-up question from the same person. Do you have projections over the next 10 years for the cold storage space?
I don't have projections. What I would tell you again is both sectors are benefiting from long-term macro trends. What we see in the traditional warehouse space is over the next year, likelihood of vacancies being sub 5% and rental growth being 5 to 6%. We see similar statistics, for example, in the US cold storage industry in terms of occupancy or vacancy and rental growth. As I mentioned to you, they both have very strong favorable fundamentals. One just has a different free cash flow component to it than the other, given the higher maintenance CapEx required to maintain the chilling capacity element of cold storage assets.
Thank you, AJ. This is a question from our good friend Bob. Bob has a strong accounting and investment background. His question is, are the projected increases in income or rents, are those increases after these projected cost increases?
So are we referring to my answer before on the warehouse assets about rental increases of about 5% or 6% on same store rent increases? Is that the question?
I would think so.
Yeah, it's not clear, but yeah, why don't you run with that?
So when we're talking about what we're seeing today in the US warehouse sector, we're looking at what a space would actually rent for today versus what that exact space would have rented for last year. And on average, across the entire United States, we're seeing that to be about 5 or 6% higher this year for the exact same space than last year. And there are geographies in the United States where it's actually much higher. For example, in Southern California, closer you get to the ports of Los Angeles or Long Beach, you could actually see high single-digit same-store rental growth. So yeah, that's like for like rental growth. In a world of low inflation, relatively low inflation, that's very attractive rental growth. And that's driven by, again, demand growing faster than supply in these markets.
Yeah, I have a couple points myself. I noticed you mentioned that you primarily only own assets in growing population markets. Well, I have to throw this in there. It's time to look at Delmarva. Delmarva is a growing population market, so hopefully we can get on your radar soon. Delmarva, by the way, if you're not familiar with that term, which many people are, so don't feel bad, it's just Delaware, Maryland, and Virginia, Eastern Shore, Virginia. So Delaware, Lower Sussex County is a popular growing market right now, especially the coastal market, as well as the Lower Eastern Shore. So I had to throw that in there. One thing I noticed in the balance of your portfolio is that the net lease asset portion of your portfolio represented about 13% of that. Can you identify what specific tenants you'd like to go after right now?
Yeah, and to be very clear, we have a very simple net lease portfolio. BREIT owns 3 net leased assets. They're all large casino hotels located on the Strip in Las Vegas. We own the Bellagio, we own the MGM Grand, and we own Mandalay Bay. And when I say we own, BREIT owns the land and the buildings. We have signed a 30-year lease with MGM, the publicly traded $20 billion market cap company, to operate those casinos. And MGM has corporately fully guaranteed, with the full weight of their $20 billion market cap, the monthly rental payments that it owes to BREIT. And so those three casinos and resort properties in Las Vegas are owned by BREIT. We don't operate those three facilities. They're operated by MGM, who has the right to operate it, and in return just pay us rent. And they pay us rent every month, and we have contractual escalators of 2 to 4% per annum to earn from MGM. And so we're essentially owners of the real estate assets, and from a credit perspective, borrowers or lenders really, and they're a borrower from us. And for us, we think it's great risk-adjusted returns to earn from a company that's guaranteeing these rent payments with their full $20 billion market cap.
So what you're saying is you're not buying Dollar Generals and Starbucks.
We are not. And by the way, we're focused on buying assets. When we buy them, yes, we want to make sure we like the credit, because we're taking a counterparty's 10, 20, in this case, 30-year credit profile. But we also want to buy these assets at discounts to what the replacement cost would be. We don't want to buy a quick service restaurant box, for example, and pay $1 million for it, even if we're earning good yield, if it cost only $500,000 to build that box. We want to look at it both from a real estate and from a credit perspective. And one of the challenges that we see, for example, oftentimes when we look at drugstore boxes or quick service restaurant boxes, when you have a CVS, Walgreens, or a restaurant credit, you're actually paying for the credit and you're overpaying for the real estate. And we want to basically get an attractive basis in the real estate, like we did in those three gaming casinos, but also get the benefit of credit. So those are the nuances.
Yeah, it's a great point, AJ, that you pointed out. We see a lot of the single tenant drugstore assets out on the market, and certainly not to knock those at all, because they can be great investments if it's a brand new 20-year lease, long-term absolute net deal. However, we do see the ones where the owner comes out and they have 3 years left on their lease term, and they're still trying to get a cap rate that's only maybe 100 basis points off of the cap rate for a brand new 20-year, 25-year absolute net deal. And your point just hit the nail on the head with that. They're trying to sell it with only 3-year security left, even though it's corporate credit and corporate guaranteed, at a real estate value that's much higher than what any other tenant could pay for. So the risk is extremely high, and I think we see a gap in the market for that. So I'm glad you pointed that out. We do have a question of curiosity from Andy. He's curious what the monthly rent from MGM is.
So, as I mentioned, we own 3 casinos, one of which is the Bellagio, which is, if not the leading, one of the top 2 leading gaming assets on the Strip. What I would tell you, in 2019, this is a casino that generated over $500 million of EBITDA. And on the Bellagio, we have about 2 times coverage. So we earn about $20 million a month in rent, just on that casino.
Is that right?
I think AJ's probably got maybe time for one more. He's got a talk he's got to get ready for.
We're actually done. That was the last question. We had one other question that was out there that was more micro specific to what we're going to cover here today. So, Mike, did you have any parting remarks for AJ before Brent?
No, I would just say thanks for bringing Wall Street down to Main Street. I think it dovetailed nicely with Dave and Kevin's comments, and I think it was a great bookend, and thank you for your time.
Mike, everyone, thank you for your time. Appreciate the opportunity.
Thank you very much, guys.
Well, thank you very much. Great information from all our speakers, Wesley, Dave, Kevin, AJ, and Ed. Thank you guys. Really, really good job. Appreciate it. For all the hundreds of folks that have joined us from all over the country today, we want to thank you for taking the time to be with us, and you will each receive a copy of our commercial real estate report. via email over the next couple of days. We also want to give a huge shout out to our partners with this event, M&T Bank, Merrill, Delmarva Veteran Builders, 100 Savings Bank, the Insurance Market, Bank of America, Farm Credit, Avery Hall, TRS CPA Group, and the W.R. McCain and Associates. Also want to thank Salisbury University and our Zoom coordinator, Mario, as well as the SVN Forum committee members that have put in countless hours to bring you this event today. Wesley Cox, Tony Inslee, Kelly Jeter, Rick Tillman, Amy Miller, and the chair of our committee, Amber Bostwick. Great work, team. Thank you very much. And again, thank you all for attending, and we look forward to working with you as we transition into the next normal. Have a great week.
Thank you guys so much. Have a good week.
Thanks, Wes. Thank Brent.
Thank you, Pat. See you, Mike.
Thanks.